And good afternoon once again, options traders. Well, a good question for our group again. Should you hold your option another day? This is one of the most difficult questions to answer in all of trading and investing, but especially with options because they are wasting assets. And we know that if you buy an option, that a portion of that price is going to decay away with each day. And so people get on the fence right here at a certain point and they go, I don't know if I want to continue holding it. I'm going to continue losing, or at least that's what I feel, but I also feel like we might be at a turning point. Should I hold it for another day? Well, as we're going to find out, the one thing that people fall back on the most to make these decisions is usually a wrong choice. So what is that? And let's find out why it's a bad idea. And before we do, as always, please be sure to click like and subscribe. Always very much appreciated and definitely helps to promote the channel. So, when to sell? The problem for most traders is that they often look at how much they've lost to determine if they should exit. So for example, let's say that you buy a $100 call, you spend 10 bucks on it, and it's now currently trading for 6. So it's fallen 4 bucks and you're down 40%. And they'll say, okay, let me sell. Now I've just chosen 40% as an arbitrary number, pick your own number, but everybody seems to have this line in the sand where they say, I'm just not going to accept any losses below this level. They might even put a stop order around this level to trigger a sell. The problem with this method is that this is a sunk cost. It's not really the best way to measure performance. So we've talked about this before. Understand that a sunk cost is any expense that is irretrievable. It's spilt milk, it's water under the bridge, there's nothing you can do about it. And because of that, sunk costs should not be part of future decisions. But when you do this, when you make your decisions based on how much you've lost, that is exactly what you're doing. And it's a very common trap and problem in what's called behavioral finance, the psychology of investing. And here's a really good example. Let's say that a Broadway ticket or some concert ticket costs $100. And we're going to look at two different scenarios. The first one is you're going to buy the ticket up front, and the second scenario is you're going to buy it at the box office. So let's take a look at the first one, where you buy the ticket up front, and then at a later time you discover you've lost the ticket. And the question is, do you buy another one? Most people are going to say no, and if they do, the next question is, how much did the show cost? And they'll say, oh, well, that's easy. I paid $200 to acquire one ticket, so therefore it now costs me $200 to see the show. Okay, so hold that thought and let's take a look at the second scenario where you buy the ticket at the show. However, when you get there, you open up your wallet and you find that you have lost $100 cash. So we're going to ask the same question. Do you buy a ticket? And now people will often say, well, of course, I'm at the box office ready to buy it. What does losing $100 cash have to do with a ticket? And so they'll say, sure, I'd go ahead and buy a ticket in this situation. But let's ask the same question now. How much did the show cost? Now that same person will tell you that they've spent $100 for the ticket, and the $100 cash that they lost had no bearing on the cost of the ticket. Well, let's find out why that's a bad approach. Let's look at what happens financially, whether you buy the ticket or not. If you go to the show, you're down $100. In one case in the form of a lost ticket, and the other case in the form of lost cash. And if you don't go, you're down $100. Again, one case in a lost ticket, the other in cash. So it doesn't matter whether you go or not. You're down $100. So this should not enter into your decision process. The question is, do you want to go? That's really what you need to look at and address, but you can see where people can get tripped up. And in some cases, they'll say, yes, I would buy another ticket, and in other cases, they wouldn't. But they're making those decisions based on sunk costs. So what should you consider? Well, one thing to look at is theta. Now remember that theta is one of our Greeks. It shows by how much your option is expected to lose from one day's passage of time. And the reason we say expected is that it depends on, obviously, if the stock price moves would be a big one, but it could be implied volatility. Theta assumes that everything else stays the same and that we just let one day's time pass. And we can look at that on our broker's platform and see how much we're expected to lose. So by looking at this, the question we can answer is how much will it cost to hold one more day? So let's go back to this option that is now trading at 6. Remember, we initially paid 10, but right now it's trading for 6. And we look at our broker's platform and it says that it has a theta of 2. So it's going to cost you 2 cents or $2 per contract, since each contract controls 100 shares. And that's what it's going to cost to hold one more day. Now keep in mind, this doesn't mean that your option is expected to fall from $6 to $4. And the reason is this number also gets multiplied by 100. It's really a total value of 600, and if you're losing 2, that means you're expected to fall from a value of about 600 down to 598. So the question really should be, is it worth $2 to hold for one more day? Not what's happened in the past. Now graphically, this is what it looks like. In this case, we have a vertical spread, and as time passes, we can see this left side is going to dip down. And the distance here that it's dropping down is your theta. And at some point, you're going to see this gap is going to start getting larger. So if the stock is in here, this would be your cost moving from the day in green to the day in purple. If the stock is up into here, you're going to see that that cost is much less. And of course, your broker's platform is going to show you exactly what that is. And then as time continues to pass, these gaps will eventually get larger. Remember that time decay accelerates as you get closer to expiration, and then it will start to decrease again, because out of the money options, which is what this is in this case, will bleed out most of their time value prior to expiration and then start to decelerate closer to expiration. So these are all things that you have to consider if you should hold your option another day. So why don't traders do this? Well, it gets right back down to the psychology of fear. They all say, but what if I lose more? Sure, my broker's platform might say that I'm expected to lose $2, but what if that stock tanks and my option falls another $1.50 or $2? Well, that's true. That is a risk that you take. However, jumping to another option doesn't increase the chance for success. If it did, if that were true, you wouldn't be down 40% in the first place. Nobody's going to intentionally jump into something that's a losing trade. So that's really just, again, psychology. You think that this one's not working out, but if I move to another one, that's going to give me a better chance for success. But let's look at another situation. What if you do jump to a new option and you're now down maybe 5 or 10%? That's not any better than the previous one being down, let's say, another 10%. This is, of course, assuming that we have the same amount of money into it, but I think you see the point. If you lose 10 more percentage points on the initial position, is that really any different than jumping to a new one that is now down 10%? The dollars might be the same. And in fact, it might even be more in the new option. Again, it depends on which option you've jumped to. So this isn't really the best way to make a decision, is to say, I'm down a certain percentage, let me move to a new option. The question that you want to address, the main point of this video, is to always ask, is the additional cost worth holding for one more day? And one of the things you can do to find that cost is your theta. So what are some things that should be some guidelines of when to sell? Well, remember, there should be a requirement or requirements that will prove you wrong. And you as a trader have the right to set up what those requirements are. Maybe it's, did the stock fall below a certain level of support? Is there an upcoming FDA announcement? But there has to be some condition that convinces you your initial outlook is wrong. The main point is to be careful of selling just because of what's occurred in the past. That's a sunk cost, and it has no bearing on future decisions. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.